Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, we're going to cover part 4 of our asset allocation series, and we're going to dive into the asset class of fixed income. I'll explain to you what fixed income assets are, how you can invest in fixed income, and what traditional fixed income assets look like. And then at the end of this video, I'll explain to you why I absolutely hate this asset class. Fixed income is my least favorite asset class of all of them, and I'll share with you the reasons why I think allocating a large portion of your money to fixed income assets like bonds can be a really bad idea. I want to be clear that this video is not intended to be investment advice. This is my own personal opinion about how I invest my money and how people that I've worked with in the past invest their money. So you need to do your own research and make your own investment decisions yourself. Let's start by diving right into a reminder about how we do asset allocation. So remember that layer 1 asset allocation is allocating among the asset classes, and here we're dealing with fixed income. Layer 2 is how we allocate within this asset class. So we're covering layer 2 fixed income, how we allocate among the different types of investments that are fixed income assets. I have separated out debt as a reminder. Yes, debt investments are really fixed income investments as well, and they're really the same, but you'll understand in the next video series why I separate those out. I think of debt investments and alternative debt investments is what I'm talking about here. I think of that as very differently than, traditional fixed income type investments or assets. So I'll explain debt, alternative debt investments in the next video of this series. So let's start with just explaining what fixed income assets are. I want to be clear about what they are for any of you who don't, typically have a lot of experience with investing, or just be clear about what we mean when we say fixed income. So fixed income assets are assets that provide a fixed stream of income while you own that investment. So it's typically interest income. So if you think of, a bond or, traditional form of fixed income asset, you are getting interest income while you own that asset. So that steady stream of income is almost always going to be interest income. And there's a number of reasons, we have to think about the returns we get on the investment, the tax treatment of the investment and that money that we get. A lot of things that we have to consider here when we're thinking about what investments make sense. Just a quick example of a traditional form of fixed income. Let's think of a corporate bond. So I'm going to use Apple. We're all familiar with the company Apple. Let's say we want a $10,000 Apple bond, and it has a coupon rate of 5% and a maturity date of 10 years. What this means is that in theory, or the way this is in practice, is that Apple has borrowed $10,000 from you. That's how the corporate bonds work. And basically the company is going to pay you back $10,000 in 10 years. So in exchange for being able to borrow that money from you, they're going to pay you interest. So that's the coupon rate here, 5%. Apple is going to pay you 5% interest on that loan that you've given to them throughout the 10 years that you hold that. And that's going to be $500 a year that you get every year from Apple in exchange for lending them that money. So that steady, stream of income, that fixed stream of income is that interest income that Apple has to pay you on that bond. People typically think of, fixed income investments as being more safe and stable. It's, traditionally thought of the safest asset class because there's such a low risk of losing your money. That actually depends on what type of fixed income we're talking about. There's definitely some corporate bonds out there. If those companies issued a bond, I wouldn't call that safe in any means. So, yes, there's things like T-bills that are very close to cash and probably, very little risk, if at all, really with that type of investment. But when you really expand the definition of fixed income assets and look at all the investments that you can make, as the returns start to get higher and higher with things like junk bonds, things like when we start to get to alternative debt investments, returns are higher. But the way that works is that the risk that you're taking on is higher. So the reason that there's so little risk of losing your money, that's the other side of that coin, is that you're not getting very high returns on those investments. So this is just a basic example of what a fixed income asset is. I'm going to walk you through some of the traditional forms of, fixed income assets. These are really things, think of like your grandparents' types of investments. These are things that, in my opinion, I think there's a trend away from these types of investments as we learn more and we're more educated. We understand that, these don't really keep up with inflation. And there's a number of reasons I'll talk about in the next section about why I don't like these types of investments. But I just want to be clear that you understand what the traditional forms of fixed income are. They're bonds. Most of us have heard of bonds. A lot of you probably have an allocation of bonds for your net worth, some piece of it to bonds. So bonds are just debt issued by, either a government, a municipality if it's a muni bond, or corporations like our previous example where Apple, had a bond and they're basically borrowing 10 grand from us. T-bills are debt issued by the U.S. government. They've been very popular lately. At the time I'm recording this video, interest rates are quite high. So people have become more interested in T-bills as the yields are a little bit higher. Those are typically viewed as the, safest. I use that in quotation marks because I actually think it's one of the unsafest investments you can make because the returns are so low. But a lot of people think of T-bills as very safe because they're basically like cash and the risk of losing your money is very small. So we all know about savings accounts. If you have a savings account at a bank where you're holding cash, they're going to pay you some interest. It's going to be so minuscule that, they might as well not even be paying it. But if you've got, a lot of money and you hold a lot of cash, you're probably doing that in a money market account. Traditionally, money market accounts pay higher interest rates than a traditional savings account, but they're still, pretty minuscule and not going to be very high. Certificates of deposit, that's really kind of a savings account with a fixed interest rate. You're really I think of it as locking your money up for whatever, usually it's like a year or two, whatever the term of the CD is, and you get paid interest from the bank for, locking up and letting them use that money for that period of time. I think those are pretty outdated. I don't think most modern investors are really spending a lot of time with CDs because the rates are so low. Annuities, so an annuity is, I always put an asterisk. I think it's very dangerous to think of an annuity as an asset. It's really not. It's really an insurance contract where, you contract with the insurance company to, pay a lump sum or pay a stream of income in exchange for, regular income payments in the future. So again, our grandparents all used annuities. They all had them. I know my grandparents had annuities. I can't imagine a lot of people are still doing this type of thing. It's really not an asset. It's not an investment. It's really more, in my personal opinion, of an insurance contract where if you can't kind of trust yourself to have the same responsibility to be able to fund your retirement, then that's the only scenario where I really think an annuity might make sense. So I don't consider them assets. I think it's very dangerous to think of them as assets. Lastly, alternative debt investments. I'm going to cover that separately in part 5, as I mentioned before. Those are fixed income assets, but they're very different, I think, than these up here that I think of as more. I'm just gonna be honest. I think these are very outdated. I'm surprised that people still spend so much time and allocate so much money to some of these, especially T-bills and bonds still seem to be popular. But, I'm not a big fan of these, but alternative debt investments, I'm going to carve that out and talk about that next in the next series. So now let's talk about why I hate fixed income. So again, I'm not shy about sharing how much I hate fixed income investments. And there's kind of 4 key reasons, really 3 key reasons. So if you've heard my previous videos, you know that I do not invest in anything that does not promise at least 10% returns and that's not a reasonable expectation of getting 10% returns on average every year from that investment. Fixed income, especially traditional forms of fixed income, are not even going to come close to that. If we're talking on the low end, like a savings account, maybe a CD in a very low interest rate environment, you're looking at 1%, 2% to maybe 6%, in a higher interest rate environment, or more, maybe a little bit more risky bonds out there. So this just isn't going to do it for me. This is a hard pass. If you're someone who really wants to achieve financial freedom, the point I really want to stress is that you cannot allocate a large portion of your money to this class. You cannot be earning returns at that rate, especially this is pre-tax, disaster after tax, which I'll talk about in a minute. But you just can't. Do the math on it and how long it's going to take you to get to your net worth goals if you're earning an average of even 6% at the high end every year, as opposed to, much higher returns that are double that, or in some cases even higher than that. So alternative debt, which I'm going to talk about in the next series, does have some higher returns, but that comes at the cost of higher risk exposure. So that's important to think about, that with this, I think with fixed income and debt, including alternative debt, when you get to the returns that, or something that I'm even going to look at, the 10% range, I personally think the risk at that point with what you're investing in becomes so high that it doesn't justify, getting those higher returns. So that's one big reason. This alone is enough for me to pass on this asset class. The opportunity cost, this kind of goes hand in hand with low returns. You are missing out on better investments with much higher returns if you allocate a large portion of your money to fixed income. Every dollar you put into a CD or to a savings account or to a bond, that is that is a big opportunity cost if you put that in a better asset class. So that's my own personal opinion. I think you cannot invest without thinking about opportunity cost. People do not understand this. This is the difference between amateur investors and more savvy, sophisticated investors, is that if you want to build wealth, if you want to achieve financial freedom, you've got to think about investing with opportunity costs in mind. So that's very important. Tax inefficiency. So most of the income, as I mentioned, is almost always going to be interest income. That's taxed as ordinary income. It's at the highest rates possible. Those high rates of tax are going to eat into an already low return. So not only are you starting out with low returns, you're, cutting that in almost a third or a half in some cases, depending on where you live, depending on what your tax rates are. So, I mean, if I wasn't passing because of this, I'm definitely passing here. So lastly, I'll just mention interest rate risk. So as the interest rates rise, the value of your fixed income portfolio is going to go down. We saw that happen, several months ago when some of the banks were getting themselves in trouble because they owned a large portion of bonds and they had to mark to market those bonds, and those bond portfolios were tanking because interest rates were increasing at the highest rate we've seen in modern history. So again, fixed income is not all risk-free. You've got to think about risk in more of a holistic modern day standpoint. I think that, if you're thinking that investing in something is risk-free, because it's safe, well, it's giving you 2% return. So you're not even keeping up with inflation. Warren Buffett calls, bonds wealth confiscators because they rarely, if at all, keep up with inflation on an after-tax basis. So you're basically guaranteed to lose money every year, in my opinion, when you're investing in this asset class. I think that this trend is catching on. There's definitely, as I mentioned, a trend away from this. Most younger, 30s, 40s, younger 50s, very sophisticated people when it comes to investing, very wealthy people I know, generally don't touch this asset class. If they do, they're in the alternative debt investments, not in this crap, that's traditional forms of fixed income. So again, that's my own personal opinion. And let's move on. This is going to be really quick here is, how much to allocate to this asset class. So, nothing. I do nothing. It doesn't matter how much money I have. I'm not allocating anything to this. At every stage of my life, I never once allocated a dime to this asset class, nor will I ever. It doesn't make sense. I've explained that over and over. This is my personal opinion. So I think though, again, I know I've said this before, but I cannot stress this enough that if you really want to achieve financial freedom early in life, you cannot allocate a large portion of your assets, of your investments to fixed income assets. The returns just don't justify it. And you're going to really slow down how much money you can make over your lifetime if you've got a large portion of your portfolio in things like bonds or, even worse, things like T-bills or savings accounts. So this was part 4 of the asset allocation series. In part 5, I'm going to talk about debt alternative investments, which I think are, also within this asset class, but a lot different in the way that they operate and the way they work. So hopefully you found this video helpful. If you did, please like the video and subscribe to the channel.